Hello, everybody. Welcome, people of the internet. So good to have you with us for today's training. I'm Rachel Nabers. You're here on the training about participant loans, solo 401k, how to be your own bank. I see there's a bunch of people coming in. It's so awesome to have so many repeat attendees too. You guys already know the drill. You already know that I'm going to ask, can you see me? Can you hear me? Tell me who you are and where you are joining us from. Okay, hi, Tracy. Just listening only if you're in the car. I promise you'll have access to the replay of today's training. Keep your eyes on the road. Be safe. And yeah, it's really good to have everyone here. You know, now more than ever, you have to be in charge of your own money. You have to be in charge of your own financial future. There's a lot of uncertainty this year with the pandemic, being in an election year. And just as we're transitioning from sort of the legacy financial system, the information era, the industrial era, coming into the information era, there's a lot of changes that are happening, and they're happening quickly. And there's a lot of exciting stuff that's happening too. You know, because we're so globally connected with the internet, we have access to deals and deal flow and investment ideas more than we ever have had before. So I'm really glad that everyone is here. So many of you are already solo 401k account holders with us. I know that there's a handful of you that are, still deciding if the solo 401k is the right vehicle for you, deciding if Nabers Group is the right plan provider for you. So we're just really stoked to have you here with us on these trainings. It's really awesome to see. You guys are wonderful sponges, and your brains are so beautiful and wrinkly. Every time you have a new learning, you get a new wrinkle in your brain. And if you've talked to anyone on the Nabers Group team, you've probably heard us tell you that Nabers Group and solo401k.com clients have the wrinkliest brains. And it's because you're hungry for this learning. And it's just so awesome to be on this journey with you guys. So, okay, well, awesome. I just see there's so much flooding in. You can see me, you can hear me, people from all over the place. It's awesome to have you all here. And so what I want to do is really just dive right in. Today, we are going to talk about how to be your own bank with the Solo 401k through a really interesting feature of a vehicle inside of the Solo 401k called a participant loan. I've prepared a presentation for you. So I'm going to go ahead and share my screen, and give me just one moment. Et voila. You should be able to see my screen now. Oh, hold on. I can't see my own anymore. One moment. I think I accidentally closed the presentation. Let me reopen that. Give me one moment here. Be your own bank, the participant loan in the Solo 401k. You guys have seen these trainings before. You know that this is not tax, legal, or investment advice. We're going to go over some really interesting concepts about the Solo 401k participant loan. And remember, you are your own boss with a Solo 401k. Always do your due diligence and make sure that you are following the right steps in the right order when you're taking money out of your retirement plan. Most of you know me. I'm Rachel Nabers from Nabers Group and solo401k.com. And again, it's awesome to have you here. So let's dive right in. Today, we're going to talk about how to get cash from your 401k. So what is a participant loan? Simply put, a participant loan is a loan you take from your 401k funds. You are the Solo 401k plan participant. And by that, I mean you are participating in your company retirement plan. So you're allowed to lend money from your 401k plan to yourself. Not all plan sponsors offer a participant loan. In fact, I know by looking at the names of the people on this webinar that some of you have restated your Solo 401k to Nabers Group specifically because your old Solo 401k plan did not offer a participant loan. And of course, we're so happy to have you as a part of our community. So how do these participant loans work? They're really cool. A participant loan is tax-free. It's tax-free money. You do not pay taxes on the temporary withdrawal from your retirement plan. It's not a taxable distribution, and there's no early withdrawal penalties when you remove these funds from your 401k. You do not add the loan amount to your taxable income for the year. So in essence, it really is temporary free money you're borrowing from yourself. How much can you get? The maximum participant loan amount is 50% of your vested balance or $50,000, whichever is less. There is an exception for a participant loan. If your vested balance is less than $10,000, you can actually take out up to $10,000. But that's, the exception more than the rule. In general, the maximum loan amount is that 50% of your vested balance or 50 grand. Again, whichever is less. Now, I said vested balance. Your Solo 401k plan with Nabers Group vests immediately as soon as you establish the plan with us. What that means is that you can open the Solo 401k and fund it and immediately take the loan from your Solo 401k plan funds. Let's take a look at a couple of examples of how we're going to reach these 401k loan numbers. The first person we'll look at is Nisha. And Nisha wants to take a loan from her 401k. We want to determine how much can she take. Nisha has $150,000 sitting in cash in her Solo 401k. She has $50,000 invested in an apartment syndication, and she has $35,000 in a brokerage account invested in stocks and bonds. Nisha's total vested balance is $235,000. We add up the $150K in cash, the $50K in real estate, the $35K in stocks and bonds. 50% of $235,000 is $117,500. Remember, participant loans are 50% of the vested balance or $50,000, whichever is less. In this case, $50,000 is less than $117,500. So that means Nisha can take the full $50,000 loan from her 401k plan. Next, let's take a look at Adam. Adam has $40,000 in cash and $150,000 invested into a private equity fund. And the funds are going to sit in the PE fund for 7 to 10 years. So Adam's total vested balance is $190,000. That's the 40 grand in cash and the $150K in the private equity fund. However, Adam only has $40,000 liquid. Remember, the $150,000 is illiquid. It's tied up in that private equity fund for the next 7 to 10 years. So in theory, Adam could take the full $50,000 if he had enough cash. Because only $40,000 is liquid, that's the maximum amount Adam can take, $40,000 in this loan. And of course, I'm looking at this in a vacuum. If Adam did a contribution or a rollover and got more cash into the account, his loan amount would go up. But if we're just looking at a snapshot of Adam having $40,000 in cash, $150,000 tied up in the PE fund, then $40,000 is the maximum he's able to take in a participant loan. Now, the cool thing is spouses can get loans too. If you and your spouse each participate in your Solo 401k, you can each take a participant loan. Loan amounts are based on how much you each have in your vested balance in the plan. Now let's take a look at Hector and Pucci and their El Cantante 401k trust. So Hector's going to roll over $200,000 from his rollover IRA, and Pucci's going to bring in $90,000 from her previous employer 401k plan. They're each going to max out their contributions. They're doing really well in their business. So now let's take a look at their total vested balance for each of them. Hector's vested balance is $257,000. That's his $200,000 rollover plus his $57,000 contribution. Pucci's vested balance is $147,000. That's her $90,000 rollover from a previous employer plus her $57,000 contribution for the year. They can each take the maximum $50,000 loan because they each have enough in their vested balance and enough cash in the plan. That means they can get $100,000 in total loans, $50,000 for each participant. So Hector can take the full $50,000 and Pucci can take the full $50,000 in their participant loans. There's a lot of different reasons that people might take a participant loan. People use their funds for a variety of reasons, actually. Sometimes someone might want to pay down debt or pay off their bills. They might need seed capital for growing or starting a business. Maybe they need some money to make their primary residence mortgage payments. They might want to flip a house. Maybe you've had your eye on a boat or a jet ski or camera gear. You can use that for business or pleasure when you take these funds from the Solo 401k via a participant loan. Or maybe you would like to do an investment that otherwise would be a prohibited transaction. Another reason why you might want to take a participant loan is if you're unable to get a loan elsewhere. We're going to cover some specific case studies of how clients have used participant loan funds in just a moment. But the big takeaway here is that these participant loan funds can be used for any purpose. With any loan, there's going to be interest. So we want to determine what is the interest rate on a participant loan. The IRS states that the rate must be reasonable and cannot be more favorable than what the participant can get from a financial institution for a similarly secured loan. In other words, they're letting us have this free money, but we can't have a totally sweetheart deal. We still need a reasonable interest rate on the loan. So what's reasonable? Standard in the retirement industry is the prime rate plus 1%. As of today, the Wall Street Journal prime rate is 3.25%. That means your total participant loan interest rate is 4.25%. I want to make a quick pause here. Your Solo 401k plan documents with us include a loan policy. This is in your 401k plan and trust documents. It's a really good idea to review this loan policy. It'll give you a nice idea of what you can do with your 401k participant loan. Let's talk about loan terms. You have 5 years to pay off a participant loan. According to the IRS, loan repayments must be at least quarterly, and each payment must contain interest and principal. There's no such thing as interest-only payments with a participant loan. All payments must include interest plus principal. And we'll provide you with a monthly repayment schedule, including an amortization schedule that already breaks down your interest and principal repayments. Now, notice in this last slide, I said you have 5 years to pay back a participant loan. But there's actually an exclusion for this. If you use your participant loan funds to pay off your primary residence or make mortgage payments or a down payment on your primary residence, then the IRS lets you have up to 15 years to pay back your participant loan. This extension is not available for interest property or investment properties. It's not available for a second home. The money has to be used for your primary residence only. If those funds are designated for your primary residence, then you can have up to 15 years to pay back the loan. Okay, I want to take a break here. I'm going to stop sharing my screen for a moment. And I'm going to share a new part of my screen. Hold on one moment here. My camera got all weird. Give me a second. Can you guys still see me okay? It looked like it switched to my webcam. Can you see me all right? Thanks, Doreen. I appreciate the votes of confidence. Thanks, guys. So I think we got the good camera, the fancy camera back on now. It should look even more profesh. But I do want to share my screen now here because what I want to do is actually walk you guys through how to take a participant loan on your own Solo 401k dashboard. So let me just log into our demo account. Give me 10 seconds here. Okay, so all right. So now you should be able to see I'm logged in to our Solo 401k document portal. And now what I want to do is show you how you can take a loan. It's super easy. So for those of you who are already Nabers Group clients, this should look very familiar to you. If you're not yet a Nabers Group and Solo 401k client, here's a sneak peek at what your Solo 401k dashboard looks like. We've got lots of goodies in here for you. And it's really as simple as clicking on this link right here that says loans. What that's going to do is open a screen here where you can prepare your loan documents. And we've got a little helpful walkthrough video that tells you all about the loan, tells you exactly how to fill out this form here. And we even have a loan calculator. So this can give you a glance of exactly how much your loan monthly payment would be. So now what I'm going to do is I'm going to go ahead and let's say I'll take a $30,000 loan and I'm going to pay it back in 3 years. So I already can see in advance what my monthly loan repayment is going to be, kind of a helpful little tool. And then it's really as simple as putting in your loan amount, so $30,000, and then selecting your loan term. Remember, you've got up to 5 years to pay back the loan, or you have 15 years if the funds are going to be used towards your primary residence. I said I'm going to do a 3-year loan, so I'll set my loan term as 3 years. Participant is where you'll input your information, or potentially if your spouse is going to be taking the participant loan from their funds, then you'll input their information. And your social's already input for you here. And then it's as simple as pressing submit. And now my loan documents are ready to download. I'm going to go ahead and download those and I'll open them up for you here in just a moment. Okay, so that was pretty fast. Took us about 30 seconds to draw up that loan paperwork. And, we'll tell you some nice FAQs here. So once you finish taking your, submitting your participant loan documents, then we'll let you know exactly what to do next, sign and date on each page, and then write the check from your 401k bank account to the borrower. Who's the borrower? You, the participant. We're going to come back to this in a moment. It's really important that your 401k loan money goes directly to you. If you're writing a check or you're sending a wire, even if you need to use the money to pay off bills, even if you need to use the money to put cash infusion into your business, this is a participant loan. That means the money goes to the participant, which is you. So sign and date on each page where applicable, and then write the check from your Solo 401k bank account to the borrower. That's you. You're the participant. And then we've got some helpful FAQs here for you. These are all going to be available for you at any time. And let's take a look at the loan documents. So we've got our nice cover page here. This takes us through a little bit about what's going to be included in the participant loan package. And then we have the loan application. Now, you are approving your own loan because you are your own plan administrator. You are your own plan trustee. But you still have to have the formal documentation because this is still a retirement plan. It's governed by Section 401 of the Internal Revenue Code. It's still a 401k. So we want to make sure you have appropriate paperwork to back up your loan. This is your loan application and approval and your promissory note. So you'll sign as the plan administrator and you sign as the participant. Remember, you are both roles in your Solo 401k. Then you've got your pledge. So you're going to sign and date here. Remember, you are both the plan administrator and the participant. Now, let's say my spouse is going to take a participant loan and he works with me in my business. I might sign as the plan administrator and my spouse might sign as participant. So the participant is the person who gets the money from their own account. And here you can see we've got our terms. So our loan proceeds, the finance charge, that's your interest, the total of all of your payments, the percentage, your interest rate, the number of payments, no loan fee. Nabers Group never charges you anything to prepare these documents. And then you can execute the loan by signing as the plan administrator and the participant. And then we've got that amortization schedule for you here. So this tells you exactly the principal and the interest that you're paying for every single payment. Remember, we calculated how much that payment would be. What did we say? 880 something per month. So this tells you exactly how much is dedicated to principal and interest. It takes all of the guesswork out of it for you and makes it really easy so you know exactly what you're paying every single month. Now, what I want to do is go back to the dashboard. I should already be logged in, and we can see here is my loan right here. So if you ever need to download a copy of your loan documents again, if you don't know where they went the first time or you need another copy for some reason, maybe you want to give a copy to your CPA to hold on file, you can always access your plan loan documents at any time right on your 401k dashboard. And remember, the loan doesn't actually become active until you take the money out of the 401k plan. So what you might do, let's say you're considering taking a loan. First of all, you can use our handy calculator here and see what your monthly repayment would be. That way you can make sure to budget and know what loan amount is going to be applicable for you to be able to make consistent repayments to your Solo 401k plan. But you can also do a practice loan. You can prepare the paperwork, have it stored on your document dashboard, and you don't even need to do anything with it. It's just a set of documents, and it's not actually funded and active until you take the money out. So if you want to look at a sample packet, you can create a sample loan packet on your own dashboard, and that way you can review it and see what's in there. And if you're not going to use it, no problem. Let's say I've decided, you know what, I don't need to take the loan, or I need to do $50,000 instead of $30,000. I can simply archive this document. Now it's no longer on my dashboard. If I ever need to, I can go to the archives, but I've got it right there. And now I can go back into the loan generator and I can take this loan, let's say for $50,000. Now, one other thing I want to draw your attention to, and then we're going to go back into the presentation because I see some really good questions coming in. We're going to address some of them in the rest of the presentation, and then we'll have time for Q&A at the end. So here on your 401k dashboard, forms is a great, very helpful list for you. And you can see right here, we've got a loan repayment form. So every time you make a loan repayment, it's a good idea to complete this form. You do not need to send a copy to Nabers Group. You just keep a copy for your own records because you are your own plan administrator. So now I'm going to stop sharing this part of my screen, go back to the other presentation. All right. Bam. Walkthrough complete. So, who gets the money? Participant loan funds must be deposited directly into your personal bank account. You cannot move money from your 401k bank account to your business bank account. That's a prohibited transaction. Remember, you're the participant. You're taking the money. Even if you need the money for your business, the money has to go through you first to your personal bank account, and then you can put the money into your business bank account. Money must first come to you and get deposited in your personal bank account, and then you can move the money wherever else it needs to go. So let's say you have a big Visa bill you need to pay down. You can't just take the money from your 401k and send it to Visa. It has to go to your personal bank account first, and then you can make your payment to Visa or whoever needs it. Who pays off the loan? The loan repayments come directly from you. Remember, this is a participant loan. You're the participant. You're the one paying off the loan. So even if the money ends up in your business bank account, like let's say you need a cash infusion, you can't just make repayments from your business bank account to your solo 401k bank account. That money has to go from your business bank account to your personal bank account back to your solo 401k account. So remember, that chain of money, that flow of funds is really important, because that's what keeps things legit, essentially, with the IRS, so that they don't become a prohibited transaction. Okay, so now what happens if I make late payments? If you fail to make a payment on your participant loan, the IRS may consider that you've done a deemed distribution. Deemed distributions are when the IRS considers the money taxable, even if that wasn't the original intent. Deemed distributions cannot be rolled over into other retirement plans. Once the money is out, it's out, and now you owe taxes. Your tax basis increases by the amount of late repayments. Remember, though, we create these payments to be the payment schedule to be monthly, but you're allowed to do as infrequently as quarterly. So if you're making your monthly payments and you're late or something happens, don't freak out. It's okay as long as you're making those repayments quarterly at least. If you start to get behind quarterly, then the IRS might consider that to be a deemed distribution. Now, what if I default? I know some people that plan to default on purpose. They take these loans. They go, you know what? I'm going to take the loan, but I'm just not planning on paying it back. If you default on your loan payments or you stop repaying the loan, the funds are considered a distribution. And typically there are taxes on a distribution. So always work with your accountant if you are late paying off your participant loan or if you are in default. Now let's pause for a moment, because I think we can all agree this has been kind of a wacky year. 2020 has been a bit much, and the pandemic was a big part of that. So what the IRS did, and the federal government, pretty much for the first time in the history of ever, is they gave people an opportunity to get money out of their 401k plans and their IRAs as well. We taught a webinar probably about 6 months ago all about the CARES Act and how we adopted the CARES Act for your solo 401k plan. I'll make sure there's a link to that so that you can check out the CARES Act webinar. It goes into great detail about the distributions and withdrawals that are available if you were adversely affected by the coronavirus pandemic. But the point I want to make here is, during the pandemic, from March to September, the IRS let people double their loan amount. And you could take out $100,000 from your 401k plan, not just $50,000. Those loan amounts and increases were only through September 22nd. And I know some people are like, are they really through September 22nd? Yes. Here is literally a screenshot from the IRS website. They say that the loan limit may be increased for qualified plan loans made from March 27th through September 22nd. Today is November 4th. That means we're back at the $50,000 loan amount. Don't go over 50 grand. As your own solo 401k plan administrator, you keep track of those loan repayments. Notate every time you make a loan repayment. Use that form. Keep track of how much you've repaid on your 401k record. So remember, we give you that amortization schedule. We also have that loan repayment schedule for you. Enter in a line item on your spreadsheet or on your QuickBooks account every time you make a loan repayment so that you have a historical, accurate record of the money you took out and how much you put back in. This is a question we get a lot. It gets a little complicated, but let's dive into multiple 401k loans. Yes, you can have multiple participant loans out at one time. The maximum total amount cannot exceed $50,000 or 50% of your vested balance, whichever is less. But there's still a little bit more math we need to do to determine if you a second loan amount. Your second loan, so let's say you've got your first loan out and now you want to take a second participant loan. Your second loan amount cannot exceed $50,000 minus the excess of the highest outstanding balance of all of your loans during the 12-month period ending on the day before the new loan. That's a mouthful. So let's take a look at an example. Here we've got Jonas. He's got $200,000 in cash in his solo 401k. He takes a $30,000 loan on March 1st. So the beginning of the pandemic, he took a $30,000 loan. And now he wants to take a second loan. So we can see that his loan repayments for that $30,000 loan from back in March are $556 per month. By now, this is starting to look very familiar to you. You've seen this loan calculator. You know how these funds are flowing. So on March 1st, Jonas took out $30,000 as a participant loan from his solo 401k. He's paying $556 back every month. And today's November, March to November, that's 8 months. So he's paid off $4,448 so far in his participant loan funds. So if we look at what's outstanding, we take that $30,000 minus the $4,448 in payments so far. And that means his highest outstanding balance up to the day of the next loan is $25,552. Now remember, Jonas has $200,000 in cash. That means his total possible loan amount is $50,000. However, he still has that outstanding loan balance of $25,552. So we have to do a little math. $50,000 minus $25,552. That's his outstanding loan balance. That leaves him with $24,448 for loan number 2. That's the total amount he can take out in loan number 2. Some of you might be wondering, well, maybe I should just pay off loan number 1 first, and then I can take the whole amount. Remember, the law bases the second loan on the maximum of all of the loans in the last 12 months. So if Jonas repaid that $25,000 in full before applying for the second loan, he would still be limited to $20,000 for his second loan because we need to take that $50,000 max minus the total outstanding balance, which was $30,000, even though he has zero to pay off now. And that means his second loan could be $20,000. Multiple loans can get complicated. Always work with your CPA or your accountant to make sure you're doing the math right. If you take out too much, it could be a deemed distribution. It's totally worth it to pay your accountant whatever their consulting fee for 30 minutes or an hour to do the math with you so that you're taking out the appropriate loan amount so you avoid a taxable distribution. Remember, once a deemed distribution happens, you can't just put the money back in. It's a distribution. So always double check your math. Now, let's take a look at a couple of common loan scenarios. So the first, flipping a property. Let's look at Madeline. She wants to flip a property. The only trouble is she doesn't have enough money in her 401k or her personal funds to do the deal. And we don't recommend that you partner with your 401k. So she's got to choose one or the other. Madeline decides that she wants to do the flip with her personal funds. The property is listed for $150,000, and Madeline has that much in her personal funds, but she's short the rehab money. She thinks she'll need about $45,000 in rehab, and then has the potential to sell for $230,000. And now I know we have a lot of real estate people on the webinar, so let me just tell you, this is not a granular example. I am not taking into account closing costs or writing off your depreciation or your cost of goods sold or your property taxes. We're looking super, super high level, just at the gross figures for this example, specifically to illustrate taking the loan. So I know that all of the real estate guys, your wheels are turning, and this is an overly simplified example. We're doing that on purpose. We just want to laser in on the loan capability and how the loan can really help. So back to Madeline. She got this property listed at, or she wants to buy this property for 150 grand. She needs to put about 45,000 into the rehab. So that means there's going to be 195,000 total invested in this property. And she's pretty confident that she can sell after she does the rehab. She can flip the property for $230,000. So $230,000 on the sell minus 195 total invested. She can make $35,000 in profit. Remember, Madeline has $120,000 in cash in her solo 401k. So she can take the full $50,000 from the 401k to her personal bank account. Remember, it needs to go right to her, and that will cover her rehab. Remember, we said the rehab is going to be about $45,000. So she takes the money from her 401k, puts it in her personal bank account, and now she can put the money into the rehab and work on updating the property. Once she sells the property, she's got that nice profit that's come back to her, and now we want to repay the loan in reverse. So the money goes back into her personal bank account, that profit from the flip, and then she's able to start making loan repayments from her personal bank account back into the solo 401k. That's one example that we see fairly frequently of clients that want to be able to flip a property, and they just need that little mini bridge loan to themselves. So that 401k participant loan can serve the role of being like a temporary loan to yourself from your 401k. Let's take a look at another example. In this example, we're going to have a client use his participant loan funds to avoid a prohibited transaction. John's daughter, Amelia, needs to borrow $25,000. John's short on cash in his personal bank account, but he has about $80,000 sitting in his solo 401k. And remember, John cannot simply lend money directly to his daughter from the 401k. She's a disqualified person. That would be a prohibited transaction. Because John can't simply take the 25 grand from his 401k and give it directly to Amelia, he needs to do a participant loan. John decides to take the $25,000 as a participant loan from his solo 401k plan. He lends the money to Amelia, and she can pay him back with interest. John then takes those funds and makes the loan repayment back to his solo 401k. So now let's take a look at how these funds will flow. We've got John's solo 401k. He's got $80,000 in there. He's going to take a $25,000 loan. That money goes into his personal bank account first, and then he can move the money into Amelia's personal bank account. Depending on whatever they've decided between the two of themselves, then Amelia starts to make loan repayments to John, and he can repay those funds back to his solo 401k. So I know we've had some questions coming in. You guys are so awesome about that. So let me stop sharing my screen. Okay, here we go. So we've got some questions here. All right. Let me see if I can scroll back up to the top. All right. First question here we've got from Brian. Is loaning money to your business different? What if you're using money to start a new business? Is there a gray area? I'm sorry, I was looking at the fancy camera. I need to look at this webcam. So this is a great question, Brian. You can't put money from your 401k directly into a business you own. It doesn't matter if it's a new business. It doesn't matter if it's an old business. It doesn't matter if it's a startup. If you own this business, your 401k money cannot go directly into it. So that means you would still need to take the money from the 401k to yourself, and then you can use it as seed capital for the new business. Long story short, don't put 401k money directly into a business you own. That may be considered a prohibited transaction. Do the participant loan, put the money in your personal bank account first, and then it can go into the new business. All right. Jim says, can you charge yourself 15% to pull outside money into the 401k as interest? Great question, Jim. The IRS is very clear that you can't have a sweetheart deal, which means you can't charge yourself a whole bunch of interest just to stash extra money into the 401k plan. And at the same time, you can't charge yourself no interest and have a sweetheart deal. You have to obey the IRS rules, which are prime rate plus 1%. That's their reasonable interest rate. Stick with that interest rate so that you're not breaking the rules when it comes to the participant loans. Standard interest rate, prime rate, plus 1%. All right. Darlene says, anyone know where the sound is on the mobile app? Oh, sorry, Darlene. I don't know about that. But as a little reminder, it's always a good idea when possible to attend webinars from your desktop because it's usually going to have more little features and bells and whistles and things like that. But we will have the replay available for you, even with this old webcam. So, the good news is you'll be able to have access to the materials, and we'll get out that replay for you later today, Darlene, or tomorrow morning. All right, let's see what other questions we've got here. David says, is the interest paid back directly to the 401k trust? Yes. Interest plus principal go right into the 401k trust. From where? From your personal bank account. So you take the money from the 401k to yourself personally. The money goes back from your personal bank account to the 401k bank account. Okay, next question from Roman. How often can you take a loan during 1 year? Or can you have more than one loan at a time? Okay, so Roman, I think that we answered your question in the presentation. Yes, you can have more than one loan at a time. However, calculating how much you can take on that second loan is going to be based on that highest outstanding balance for the last 12 months. So always work with your CPA or your accountant to make sure you're not taking out too much. If you take out too much, deemed distribution, you're going to owe taxes. All right. Ooh, great question here from Roman. Are there any prepayment penalties? No prepayment penalties. It's okay to prepay off the loan in a lump sum. However, remember, Roman, if you're doing this with the purpose of taking out a second loan, it's not always advantageous. Remember, we saw in Jonas's example, even if he paid off the first loan in full, he still has to subtract the highest outstanding balance from the second loan. So sometimes I think people think, I'll take out 50 grand, I'll pay back 50 grand, I'll take out 50 grand, I'll pay back 50 grand, I'll take out 50 grand, I'll pay back 50 grand. It doesn't work that way with the IRS. They are going to, because they don't want you to just use the 401k as your own personal piggy bank. So they are going to throttle a little bit how often you can take these loans. All right. We've got a lot of questions coming in here, so we'll see if we can get to all of them. We've got about 10 minutes left here. Okay. Whew. All right. Let's see. James says, so if I'm investing in a syndication for one unit, I can invest in an LLC which owns that share instead of a participant loan. I would need more details about this deal, James. If your 401k is going to be an investor, then yeah, your 401k can absolutely invest in real estate. We've taught actually webinars on this in the past, how your 401k can invest directly in real estate, single family rentals, commercial land or commercial properties, farmland, apartment syndications, REITs, all of these are allowable investments from your actual 401k trust. So if you want to put 401k money into a syndication, an LLC as a limited partner, that's allowable. You do not have to take a participant loan and then invest personal funds. Now, there might be more to your question that I'm not aware of, James. So that's sort of the broad brush strokes of it, is that the real estate is an allowable investment. Your 401k can invest directly in real estate, such as apartment syndications. Okay. Shankar says, if I take a $50,000 participant loan and use it towards a portion of a down payment of a rental property, does that loan show in my personal record when banks run credit checks and affect my DTI? No, it doesn't, because this is a personal loan from your 401k to yourself. When the major credit companies are running credit checks, they can't see this participant loan. It's a private loan from your own retirement plan to yourself. So it should not adversely affect your credit score at all, or your credit report at all, because it's just a private loan from your 401k to yourself. Okay. Next question. You guys are killing it today with these questions. I love it. Okay. Craig says, if you are serving as a private money lender and using solo 401k funds, is that considered a participant loan? Love this question, Craig. The answer is no. Your 401k is simply being a lender. Now, just like with James's question, when I said we need a little bit more information, we have to figure out what else is going on here. I would say it depends who is on the other side of the transaction. So if your solo 401k is being a hard money lender and you want to lend money to yourself or to your dad or something like that, then a participant loan is a better option. Why? Because the parties on the other side of the transaction are disqualified. It's prohibited for your 401k to directly lend money to your dad as a hard money lender, for example. It's prohibited for your 401k to be a hard money lender to you personally. If you are on the other end of the transaction, or if a disqualified person is on the other end of the transaction, the participant loan is going to be a better course of action. But if you're simply talking about your 401k being a lender, then that's totally fine as an allowable investment in a 401k plan. Okay. Ooh, Salmil, this is a great question. I'm going to tell you already, I don't know. Related to the primary home exception, can I pay off a solar loan in 15 years? So you've bought solar panels for your house. Can you use the 15-year exception to pay off the solar panels? I don't know about that. Part of me would argue that it should be allowed because it's an expense related to your primary residence. But the other part of me is wondering how literal the IRS would get when it comes to that exception, and it's not being used towards a down payment or a mortgage. So I don't know if that would be allowed. I will humbly defer to your CPA, accountant, or legal counsel for the answer to that one. All right, we've got about 5 more minutes here. So let's see. Okay. So Saba says, how soon can Madeline take another loan once she paid off the first loan? So remember, we had in our example that Madeline wants to flip a property. So, and she doesn't have enough cash in the 401k or her personal account to do the deal. So she takes a loan from the 401k to cover the rehab. As soon as she pays off the loan, she can take another loan immediately. The amount of money she can take in the second loan is going to be dependent on her highest outstanding balance in the previous 12 months. So you don't have to wait a certain period of time to take another loan. What you have to do is calculate how much is allowed in the second loan. Okay. Oh my gosh. I don't know if we'll get to all these questions today. We might need to do a 2-parter on this one, but you guys are rocking it. So let's see. Our next question is from Shankar. So following up, When the lender is closing on my loan and finds that part of my down payment for a rental property is coming from a participant loan, will he flag it anyway, given the lender puts us through such strict scrutiny nowadays? Well, so I'm not your CPA, Shankar. I would strongly recommend that you speak with your CPA. But, once those funds are participant loan funds, they are yours. So I think it really depends how granular the lender is getting when they want to determine source of funds. If you're able to say that they are income from your business earnings, then that's true. They did go into a retirement plan. But I think that you need to speak with your CPA or even with the lender to find out how granular they are going to get when they are detailing the source of funds. So that's a question for your CPA, Shankar. Okay. Here we go from Russell. Example, I have a note payable to the 401k that has a face value of $100,000. It's making monthly payments into my 401k. My 401k decides to get a loan on that note so it can get some cash. Then I decide to take a participant loan on that cash. My payments go from my personal bank account into the 401k bank account. And then my 401k makes monthly payments on the loan. Is this possible? 401k has a note worth $100,000. Payments are going into the 401k. You're getting a loan on that note for some cash. Then you're taking cash out of the 401k for a participant loan. You put the money back from the personal bank account into the 401k, and then the 401k makes the payments on the outstanding note. Probably possible. Also a good question for your CPA or legal counsel. I think it really depends how literal you're getting on IRS stuff, you guys. So, the IRS says your vested balance. If you have assets in your 401k with us, they vest immediately. So if you have $100,000 in there, let's just say that's the only asset that you have, Russell, just to make it a really simple example. Then you have the ability to take $50,000 as a participant loan, but you don't have $50,000 liquid. So what you're trying to do is, move things around so you can get $50,000 liquid so that you can take that $50K loan from your vested balance. It may be possible. I think that you need to speak with your CPA or legal counsel to make sure that they can give you their blessing on the deal. Whenever it comes to the IRS, putting money in, taking money out of a retirement plan, just get your CPA or your legal counsel involved. It's totally worth it in that little short-term cost to make sure that the long-term value of your 401k remains. Okay. I think we've got time for maybe 2 more questions here. So Shankar says, if a $100,000 distribution has already been taken as a part of the CARES Act, can I still take the $50,000 participant loan this year? Is there a minimum balance that needs to remain in the solo 401k, given I have just barely above 50K in the solo 401k? So you really have 2 questions there, Shankar. The first is, if you've already used $100,000 in your CARES Act distribution or CARES Act loan, can you take another $50,000? No. The IRS has their maximum loan amounts. That's $100,000 if you took it during the CARES Act allowable period, or $50,000 any other time. The IRS will not allow you to mix and match loans. So if you already took out $100,000, you have exhausted your total amount available to you. Let's say that you just took a $50,000 loan, then you would have exhausted the $50,000 available to you. Part of the reason why the IRS sets the maximum at that 50% is specifically because they want you to have collateral. They want you to be able to secure the loan with the assets you have in the 401k plan. So I think in your case here, Shankar, you've already exhausted the $100,000 that you have available because you took out that CARES Act loan. So unfortunately, in this instance, an additional $50,000 would not be available in a solo 401k loan. All right. So we've got time for one more question here. Let's see. We're going to go ahead and the camera stopped working. So we went old school today with the webcam. So all right, one more question here. Let's take this question from Matt. Do we have to file anything specific with our tax filing regarding the loan or repayments? No, you do not. So remember, we said this is kind of temporary free money. So temporary tax-free money, and that gives you the ability to have, you don't have to chart any of those loan amounts or loan repayments on your tax return. But similarly, and I know I've got a bunch of real estate people in the audience today, similarly, guys, you're also not able to deduct the interest from your participant loan. The money comes out of the 401k plan, it goes right back into the 401k plan. I know that we have other questions here. We are out of time for our webinar today. This training was so excellent. I'm so glad that you guys had so many awesome questions. What we'll probably do is either later this year or early next year, we'll do a round two. We'll do another training on these participant loans where we can really dig in and go over some more examples for you. It's been so awesome to have you on today's training. We love getting a chance to spend time with you and really dig into the Solo 401k. It's such an interesting vehicle, and to be able to take these funds from your 401k to yourself for any purpose is just really special. So I hope it was helpful to learn a little bit more about the participant loan today. I hope it was helpful and valuable for you to be able to see how you can take that loan from your own 401k dashboard. Remember, those tools are available to you 24/7. So log into your 401k dashboard, check that out, and let us know if you have any other questions. We'd love to hear other topics that you're interested in us covering. We hope you have a wonderful rest of your week. Stay safe, and we'll see you in the next training.